In this video, I'll show you how to calculate depreciation using the straight line method. This method assumes that the value of an asset drops linearly and is the most common method of calculating depreciation in the UK. In our example, we will assume that a company has bought a machine which costs £50,000, has a salvage value of £6,000 and an expected useful life of 10 years. The expected useful life is an estimate of the economic life of the machine, while the salvage value is an estimate of the resale value of the machine at the end of its economic life. We can build a depreciation schedule to show the value of the asset over its useful life. Firstly, let's calculate the annual depreciation charge. As per the formula below, this is the cost of the machine, which is £50,000, minus the expected residual value or salvage value, which is £6,000, and we then divide this by the useful life of the machine, which is 10 years. Before we click enter, we're going to add absolute references to ensure this calculation remains static as we drag the cell down. Therefore, each year, the machine loses £4,400 in value according to the straight line method. Next, let's add the cost. The original cost is £50,000, which remains the same each year. So again, we can apply absolute references and drag this down. The accumulated depreciation can be calculated by using a running total. We type equals sum. First input cell C10, which contains year 1's depreciation figure, followed by a colon and then C10 again. In other words, we're finding the total within the range C10 to C10, which is simply the value of cell C10, the year 1 depreciation figure. Now, before we drag this formula down, we're going to add absolute references to the first part of the function to ensure that this remains static as we drag it down. Therefore, this calculates the accumulated depreciation each year. Finally, we can calculate the net carrying value. In other words, the outstanding value of the machine each year. This is the original cost minus the accumulated depreciation. Notice that when we drag this down, the net carrying value in year 10 is £6,000, which equals our salvage value. The final year's net carrying value must always equal the salvage value. If not, it means you calculated something incorrectly. Also notice that the value of the assets drops linearly in a straight line, which is why it's called the straight line method. Some argue that this is not realistic and that most of the asset's value will drop in the first few years. To account for this, we can use the reducing balance method, which I cover in the next video. Next, I'll show you a shortcut for calculating the annual depreciation charge. As a reminder, in our depreciation table, we used this formula to calculate the annual depreciation charge. If you ever forget the formula, then you can use Excel's SLN function to calculate the annual depreciation charge. So we type equals SLN, first input the original cost, followed by the salvage value, and finally the useful life of the asset. This returns £4,400, which is exactly the same as the annual depreciation charge we calculated earlier. To summarise, we first covered how to set up a depreciation schedule to show how an asset's annual depreciation, accumulated depreciation, and value changes over time according to the straight line method. We then discussed an alternative method for calculating the annual depreciation charge using the straight line method, which involves the SLN function. Next time, we'll discuss the reducing balance method, which is an alternative way of calculating depreciation. Please give this video a thumbs up if you found it useful, and subscribe to the Excel Hub for weekly Excel tutorials, techniques, and examples.